Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cstone Pharmaceuticals' annual report. Cstone Pharmaceuticals is a biopharmaceutical company that specializes in developing anti-cancer therapies to address unmet medical needs globally. The company offers several products, including CJMLY, sujimilumab, GAVRETO, pralsetinib, and AYVAKIT avapritinib, which are used to treat various types of cancer such as non-small cell lung cancer, gastric adenocarcinoma, esophageal squamous cell carcinoma, and thyroid cancers. In addition to these products, Cstone Pharmaceuticals has a robust pipeline of innovative therapies. These include nafazinlimab, CS1003, a PD-1 antibody for the treatment of hepatocellular carcinoma, as well as several other compounds such as CS1002, CS2009, and CS2011, which are being developed to treat solid tumors. The company's product portfolio also extends beyond cancer treatments. Cstone Pharmaceuticals is developing therapies for autoimmune diseases, including CS2013 and CS2015. Furthermore, the company offers products like CS5007, CS5005, CS5008, CS5005R, CS5006, and CS5009 to treat solid tumors, while CS5001 is being developed to treat both solid tumors and hematologic malignancies. Overall, Cstone Pharmaceuticals has established itself as a leading biopharmaceutical company with a diverse portfolio of innovative cancer therapies. Cstone Pharmaceuticals' market capitalization of $12 billion is materially smaller than most of its industry peers of roughly $26 billion. Cstone Pharmaceuticals trades at a higher price-to-book ratio of 31.83 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 74% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are largely influenced by a few key factors. On one hand, revenue decline is primarily attributed to a decrease in sales of pralsetinib, as well as a reduction in license fee income due to upfront fees and milestone payments received in 2024. Additionally, an increase in cost of revenue and research and development expenses have also contributed to the decline. On the other hand, revenue growth can be attributed to an increase in sales of pharmaceutical products, including avapritinib, pralsetinib, and sujimilumab. Furthermore, royalty income from sujimilumab has also seen a significant increase, contributing to overall revenue growth. The company's ability to expand its customer base outside of mainland China has also led to an increase in revenue from this region. Overall, the drivers of revenue growth or decline are closely tied to the performance of specific products and the company's operational expenses. By understanding these key factors, stakeholders can gain a better insight into the company's financial health and future prospects. The net income of the company remained unchanged. However, there was a notable shift in profit margins, which saw an increase. This change can be attributed to two key factors: the domestic supply launch of AYVAKIT and the localization production approval of GAVRETO. The domestic supply launch of AYVAKIT played a significant role in driving up profit margins. With this move, the company anticipated a substantial increase in gross margin. This was a strategic decision that allowed the company to tap into new markets and capitalize on untapped revenue streams. As a result of these initiatives, the company's profit margins expanded, contributing positively to its overall financial performance. The successful implementation of these strategies has positioned the company for continued growth and success in the future. The company's financial performance indicates a strong ability to generate cash from its operations. A key indicator of this is the net increase in cash and cash equivalents, which stands at $365,762. This suggests that the company is successfully converting its profits into operating cash flow. Furthermore, the operating cash flow status is explicitly stated as positive, providing clear evidence of the company's financial health. Overall, these indicators confirm that the company is indeed generating positive operating cash flow. Management's commitment to innovation and growth. The company's management team has outlined its commitment to advancing a robust pipeline of innovative products through internal discovery, R&D investments, and strategic partnerships. This approach is expected to drive growth and enhance global patient health through innovation. Key catalysts for 2026 include accelerating the clinical development of certain products and advancing early-stage candidates into clinical stages. Management's vision is centered around being a pioneer in enhancing global patient health through innovation. Since its inception, the company has made significant strides with the launch of 4 innovative drugs and approvals for 21 new drug applications covering 9 indications. This progress demonstrates management's dedication to delivering on its promise of innovation and improving patient outcomes worldwide. The company's financial strategy has been focused on growth rather than distribution of profits to shareholders. One key aspect of this approach is the decision not to pay dividends, which means that investors have not received any direct returns in the form of cash payments. Furthermore, the company has also chosen not to engage in share buybacks, a common practice used by companies to reduce their outstanding shares and potentially boost stock prices. There are concerns about inventory buildup or supply chain disruption affecting a company's operations. One concern is the potential for inventory write-downs, which can negatively impact revenue. Additionally, early billing of certain supplies under the Patient Assistance Program may be necessary to mitigate customs clearance risks due to trade uncertainties. The company has also taken steps to prepare for inclusion in the NRDL, National Reimbursement Drug List, which involves channel compensation and inventory write-downs totaling $146.9 million. These measures suggest that the company is proactively addressing potential supply chain disruptions, but the underlying concerns about inventory buildup remain a concern. That concludes the financial summary for Cstone Pharmaceuticals. Feel free to comment below, and I will be happy to answer them when possible.